And hello, and a very welcome to everybody. Today we are delighted to have Giles Dixon. Hello Giles, how are you doing?
I'm very well, Sarah. How are you?
Very good, very good. Giles is an expert on contracts, on law. We're excited to have Giles here today to help us. You have a lot of really good information to get out today. Today we're going to cover business structures and shareholders agreement, a really big topic. We get asked a lot of questions on it ourselves, so I'm really looking forward to hearing what you have to say on that. So thank you so much for doing that, Giles. I very much appreciate it. Just to say to everybody here that we will be having a little bit of a Q&A at the end. If your question is not answered, do please email us either at web@startuprichmond.com, or what's the best email to get you on, Giles?
You can send it to giles@gilesdixon.com.
Okay, giles@gilesdixon.com, and there will also be a link to the slides. You should actually be able to see that at the bottom of your screen at the moment. Yeah, there you are. So, Giles, let me hand it over to you.
Okay, thank you very much. There are basically four types of business structure in the UK: a sole trader, partnership, a limited company, and a limited liability partnership, or an LLP. The liability of a sole trader or a partnership, or the partners in a partnership, is unlimited, whereas in the case of a limited company or an LLP, the liability of the owners is limited, in the case of a company, to the amount that's not paid up on their shares. If two or more individuals are setting up a new business, it's sensible to have a written agreement that sets out at least the very basic terms that they're agreeing between them. First of all, the ownership of the business. What percentage will they have? What will their investment be? Will it be cash, or maybe know-how, or some other way of putting their input into it? What will be the decision-making processes? Who decides on what? Do they all agree on everything, or does a small group of them agree? A profits policy. Will you be distributing profits right from the beginning, or will you be waiting until you've paid back some of the capital before you distribute profits? And you also need to have a way of allowing people to leave if they need to or want to. In the case of a limited company, it will have articles of association that deal with these various issues, but the articles tend to be a model form that follows a standard format, and an agreement between the shareholders, which is confidential, can have advantages. In some cases, the shareholders' agreement may be registrable, but I won't deal with that here. I will go into the terms of the shareholders' agreement. First of all, it will state what the ownership structure and the investment will be. In other words, what's the share capital of the company, how many shares will be issued to each of the shareholders, and for how much? Or if it's not for cash, is it for some other asset or know-how that they're bringing into the business? A company is owned by its shareholders, but it's run by its directors. Now, in a small company, they're often the same people, or some of them are the same. But the decision-making processes operate at the two levels, either the shareholders at a general meeting or the directors at a board meeting. So in your agreement, you'll want to set out who the directors are going to be and how often you will hold board meetings and what will be the procedure, how much notice will have to be given, can anybody call a meeting at any time, and what will the voting rights of the directors be. Sometimes the voting rights can be loaded in favour of a director who's a majority shareholder, for example. Also, who's the chairman going to be, and will the chair have a casting vote if there are equal votes for and against a resolution? The other item that you would want to cover in the agreement is any reserved matters. In other words, decisions of the board, because it's the board who manage the company, decisions of the board that require the approval of all the shareholders or a substantial majority of the shareholders before they can go ahead. For example, it could be the issue of new shares, borrowing in excess of agreed limits, purchase or sale of major assets, giving guarantees, which could put the company into trouble if guarantees were called, and so on. So the other important area is what happens if somebody wants to sell. In a private company, you can't simply sell your shares to any third party. All shares will be under the control of the directors, and they have to approve a new shareholder. And the normal procedure with a private company would be to have a provision which says that if any shareholder wants to sell their shares, they would first have to offer them to the remaining shareholders, and if they all want to buy, they'd buy on a pro rata basis. If the price isn't agreed, then it would probably be referred to an independent firm of accountants who would decide on a fair price, and then there would be a procedure for completing the sale and for the shares being paid for. If the other shareholders don't want to take up the shares of the departing shareholder, then that individual is going to be stuck with the shares because they don't have to buy them, and he can't force a sale unless the agreement says something to the contrary. And the other thing is that this arrangement would also apply in the case of the death of a shareholder, so that the executors could offer the shares to the remaining shareholders, or indeed probably the shareholders would want the right to buy back the shares from the deceased. There are other situations where shares in a private company might be sold. First of all, there could be a clause which provides for a shareholder who commits some material breach of the agreement to be bought out by the others and to be basically expelled from the company. Whether or not his shares in that situation are paid for at a fair value or at some other price would be for something for the agreement to specify. Another situation could arise when the company is doing well, somebody comes along and offers to buy all the shares in the business. Now, if some of the shareholders, say a majority, decide that they want to sell, they may also want to be able to compel the minority shareholders, anybody who doesn't agree, to come along with them. And there's usually a clause which is called a drag-along or tag-along clause, where the majority can drag the minority along so that the whole business is sold. Or the other side of that is, if the majority want to sell, the minority can say, well, if you're selling, we can sell too, all at the same price. Another potential situation is where you get a deadlock, some major business decision which is needed, and there's a complete split between the shareholders. One side want one thing, the others want something else, and that's holding up the business of the company. A deadlock clause can be written into a shareholders agreement, which essentially has a procedure for dealing with it. The first stage would probably be for the deadlock to be identified, put down in writing, and for exchange of views in writing between the shareholders. If agreement can't be reached within a specified period, then the deadlock could be referred to a mediator, an independent mediator, who talks to the parties individually and together to try to help them reach agreement. And if that doesn't work, then there could be provision for one side or the other to be bought out, or possibly, and the ultimate solution, is for the company to be wound up. But that is not something that one wants to have if it can be avoided. Turning to partnership agreements, a partnership agreement, a written agreement, is really more important than it is with a company, because a partnership is just an arrangement between individuals, and the terms on which they operate together have to be written down. There's nothing registered at Companies House with the partnership, and there are no formal articles of association. And as I said earlier, every partner is jointly and severally liable for the debts of the business. In other words, a third party can make a claim against any one or all or some of the partners. So the other thing is that without an agreement, you have to fall back onto the Partnership Act of 1890, a very old statute, but a well-written one. And with nothing in writing, then the partners are assumed to have equal shares and equal liability. The key terms of a partnership agreement are similar to a shareholders agreement. You'll need to insert what the name of the business is going to be, or is, the nature of the business, and the date that the partnership starts. In the case of a company, of course, it will be the date of incorporation. Again, as with a company, you'll want to say what the capital contributions of the individual partners are and their profit shares. And capital and profit shares are not necessarily going to be the same. They could be different. The other thing is that a partnership agreement will normally provide for drawings. In the case of a company, some of the directors would be employees of the company and they will get dividends at the end of the year. In the case of a partnership, it's usual for the agreement to specify that each partner will take out a certain amount on account of his share of the profits on a monthly basis, rather like a salary. And the agreement will specify what happens if there isn't enough money to pay them all. Maybe some reduced drawings should be taken, and if any partner draws more than his share of the profits over the accounting period, then he'd have to pay it back when the accounts are finalized. So the agreement will also set out the management and decision-making processes. I mean, usually it will provide for regular partnership meetings, who will chair the partnership and what votes people will have, normally one vote per partner. In some businesses, there will be a management committee who are delegated to make some of the day-to-day decisions, and other decisions come to the full partnership. The agreement will also cover the preparation of annual accounts and probably monthly or quarterly management accounts. There could be a clause dealing with partnership expenses. What are the permitted expenses of the business? And also holidays. How much holiday can each partner take, and are there any restrictions? For example, should there be not more than 2 partners on holiday at any one time? And occasionally a partnership agreement will allow for a sabbatical after, say, 5 years as a partner. An individual partner may be able to take 3 months or 6 months off. Although I was once in a partnership which had a sabbatical clause, but I was told that any partner who wanted to use it needn't expect to come back at the end of his sabbatical. The other issues to be covered are the retirement or death of a partner. What happens on his death? There will be capital and a profit share to be paid. Sometimes the agreement will provide for the capital to be repaid over a period of time, because depending on how much is involved, it could be a strain on partnership resources. And also, as with a company, if a partner misbehaves or is causing a problem, the other partners will need the right to remove him from the partnership, to give him notice. And following departure of a partner, there may be restrictions so as to prevent a partner setting up in a similar business within, say, 10 miles of the existing practice, depending on the nature of the business, and also a prohibition on poaching staff who've been working for that particular individual or for the partnership. Finally, a few words about an LLP, or limited liability partnership. As with a company, it has to be registered at Companies House, but there are no articles of association, and so the LLP needs to have an agreement between the members. The partners are referred to as members, which is very similar to the partnership agreement that I've just been talking to. I mean, one difference is that an LLP needs a couple of designated members, i.e. that is the individuals who are named, who are responsible for filing the accounts and other relevant details at Companies House. The company, the LLP, itself has limited liability, and so the members are protected. But as with an ordinary partnership, the members of the LLP are taxed on their share of the profits. LLPs are used a lot by professional firms, accountants and solicitors. A contract store sells a whole range of legal documents, and we do have templates for most of the things I've been talking about, for a shareholders agreement, different sizes of company, partnership agreements, and an LLP agreement. And also there is a deed of adherence, and that's an agreement between the existing shareholders in a shareholders agreement and a new shareholder who comes in at a later stage.
And there we are. So, Giles, thank you very much for that. That was absolutely excellent. I learned a lot of things in that, and I really like it when I get to learn things too.
I'm sure you knew a lot already.
Well, yeah, but you added more bits on, and it's always those little bits that kind of catch you, you know, particularly those clauses you were talking about, you know, so the drag clauses and things like that.
Oh, yes.
I hadn't really had to deal too much with that one. You know, so far, but so that was very interesting.
Yeah.
So I have a few questions for you here, if that's okay. So
I'll do what I can.
Very good. And again, look, just to say, if the questions that you want aren't answered here, do email them to us. We'll give you the email address at the end, and we'll get those over to Giles, and he'll get them answered for you. Is that's all okay with you?
I'll do what I can.
Very good.
When I got to available time. Yes.
Excellent. Okay. Just a quick question that I had there, because you talked a lot about, you know, the formation of companies and the shares and things like that. Is there a sort of a common setup for a limited company? You know, is it sort of based, okay, we have 3 people, so therefore it's 33% each, or is it based on the capital that people put in, or what's the most common thing that you see there?
There's no clear answer there, but normally if it's 2 or 3 people setting up a new business, and they've all got approximately an equal interest in it, then it will probably be 1/3 of the shares each.
Right.
If it's 3 of them, or 50-50 if it's 2. But you could have a situation where, for example, there are 3 people, 2 of them are going to be running the business, and a third is putting 100,000 quid in by way of capital, but isn't going to be participating in the business. So in that case, you might have the majority, the man with the money or the woman with the money, having the majority of the shares, and the other 2 a smaller share.
Okay, so just, I guess, whatever feels equitable to you.
It's whatever feels equitable, yeah.
Okay.
And that's why you need an agreement, because I mean, you can form the company with those shares at Companies House, but if you haven't got an agreement as to how the thing's going to run, it could be more difficult.
Okay. Well, that makes sense, I guess.
Yeah.
That makes sense. All right. And so just another question on that, on sort of the formation as well, is do you ever see that people put, you know, job descriptions into the shareholder agreements?
Yes. I mean, if certain individuals have certain functions, that can be written into the agreement. Similarly, if, for example, the head office is going to be in the premises owned by one of the shareholders, that should be covered. But in the case of sort of job descriptions, you could have a situation, or you may well have a situation, where one of the shareholders will be, have a particular function, and he will also have an employment contract with the company as well as being a director.
Okay. All right. So it can happen.
It can happen, yes.
It can happen.
Yes,
okay.
certainly.
So not that unusual.
No, it's not that unusual.
Okay. Very good. Okay. And then talking about, I mean, that's the formation, but the other side of it, we often get a lot more questions when things have gone wrong, essentially, or they want to exit and so on. And of course, it's very difficult to, you know, bolt the door after the horse has gone,
Absolutely.
so to speak. But I guess a couple of questions around that. So the first one that I have is around goodwill. So you hear people talking about goodwill all the time. I mean, how easy is it to value that, or to put that in as part of the agreement? Because I guess it's in an intangible at the beginning, isn't it?
Well, yes, it is an intangible, and that's really something which you need to talk to an accountant about rather than me.
Okay.
Yeah.
Okay. So.
But goodwill in a partnership too is another factor, which you may or may not want to include when you're valuing the sale of the share.
Okay. But I mean, wouldn't goodwill be better to include because it increases?
Oh yes,
the
it
price?
does.
Yeah.
It does. Yes. But how you value it is quite a complicated thing, which I wouldn't want to advise on.
Okay, well that's fair enough. I know there's many different ways to value companies out
Absolutely.
there. It was just a question because we do get asked about that because it's such a difficult one. It's not like, okay, well the sales were X and the profit was X and whatever. You know, it's down to, I suppose, an opinion, really, isn't it?
It is. Yeah. Well, it's a question. I mean, at the end of the day, if you're valuing the shares, what is this company worth to a third party?
Yes.
And what are these shares worth? I mean, one thing that is quite often in the shareholders agreement, if a shareholder is leaving and they're a minority shareholder, you will probably have a provision which says that the fact that it's a minority shouldn't be detrimental to the valuation. In other words, you take the overall value and that percentage value of the business, which could include goodwill, is what they get.
Okay, all right. So that actually makes it a lot more straightforward, really, doesn't it? Okay. Just again talking about sort of the end of the things. That's where, as I said, a lot of the trouble kind of comes in. But in the case of when somebody dies, what happens if none of the other shareholders want to buy out the shares? What can you do there?
Well, then unless the agreement allows for the heirs or the executors of the deceased shareholder to force a sale, then the remaining shareholders will have some new shareholders in the company.
Okay, and so that
who are the heirs? Whoever inherits those shares under the deceased will. Now that could be it could be a problem for the remaining shareholders, depending on who it is, particularly if it was a majority holding, because it could quite substantially change the shape of the business. So I think that's something that an agreement ought to think about and cover, really.
Okay, because I mean, anything can happen, obviously.
Exactly.
And if you've worked very hard, you want to keep the company going the way that you want it.
Yes.
And I guess if somebody can just walk in and go, "Whoop, we're going to go a different direction."
Exactly.
That's quite a scary prospect, really, isn't it?
Absolutely, yes. And you want to protect against that. I agree.
Absolutely. Okay.
Yeah.
All right. So again, let's just say then a company has closed down. Can an old shareholder reopen or start a new company under the same name? And would they be able to take the database, I guess, with them? Would that be a thing?
Well, if a company's been wound up, the database is an asset of the company, and therefore subject to data protection rules. If it's a list of corporate clients, that might be something that is sold to a third party, or indeed to one of the shareholders who wants to set up a new business.
Okay.
I mean, provided that you get the name cleared with Companies House, you can form a company with the same or similar name. But forming a new company, even with the same name, doesn't mean you have any right to the assets of the old business, because they were with the liquidator and they go wherever. But having said that, if there's a database in the old company that nobody wants, a new company is formed, the individual shareholder has probably got the information anyway on his computer.
Yeah.
What's to stop him unless somebody else has some rights over it?
Okay. All right. So again, this is kind of it's a grey area, not just in this, but also if somebody leaves a company, you come across this quite often as well.
Yeah. If somebody leaves a company, that's why I said you need a restriction. I said this with regard to partnership. I didn't actually with regard to a company, but it's just as important that if somebody leaves a company, the remaining shareholders will want to protect the data and to stop the outgoing shareholder from taking anything with them, soliciting business from existing clients and so on.
Okay, which makes sense as well. Again, I've seen a lot of people go, "Oh, we should have had that in there," but they didn't, and then it's very little they can do to argue that case.
It is quite difficult, particularly if the outgoing shareholder was responsible for some of that business in the company.
Right, they hold a personal relationship, for instance.
Precisely. I mean, it can be very difficult to stop that altogether. And indeed, in some cases, if somebody comes into a company as a shareholder with a raft of business, they'll probably want the right to take it away with them if things didn't work out. I mean, that's another thing that a shareholders agreement can do. So that, you've got two people, maybe two separate businesses which join together. If it doesn't work, they may want in their agreement a provision which says, if it doesn't work between us over the first 18 months, then we'll split, and this is the way we'll split. So we'll go back to where we were. And that's quite a sensible way of doing things.
Yes.
If you're at all unsure as to how it might go.
Okay. All right. Well,
but as a general rule, though, yes, you don't want a shareholder walking away and taking the business.
Yeah,
exactly.
The disaster. A disaster.
Yeah. Okay. I mean, there would normally be a I didn't mention it, but there would normally be a confidentiality clause in any shareholders agreement, which does protect the confidentiality of the business.
Okay, and that makes sense as well.
Yes, exactly. Yeah.
A lot of this is really common sense, I guess. But
it is.
Sometimes you don't think of this common sense until you come up against the problem, do you?
True. And even if you've got a confidentiality clause, it's better to also have a no competition clause as well, because confidentiality on its own is a bit weaker than
Right.
some of the restrictions that you could impose.
Of course, that makes sense. That makes sense. Okay, so last question I have here is, you're talking a lot about the differences between a partnership and a limited company. So why would you set out a partnership instead of a company? It seems like better, or is there what are the circumstances where you'd want to set up either one?
Well, professional practices, GP practices, for example, are normally partnerships. Law firms and accountancy firms, partnerships. In the old days, a professional firm was not allowed to operate except as a partnership, as individual partners. That's all changed, and most professional practices now, certainly accountants and lawyers, are LLPs, which is the sort of the intermediate. But if 2 or 3 people are setting up a new business, selling goods or services, it would normally be sensible to go the company route rather than the partnership, because you don't have that individual liability as a shareholder in a company as you would as an individual partner.
Right.
On the other hand, a partnership is a group of individuals providing services to their clients. It's a very personal thing. The tax situation is nice and simple in the sense that they pay tax on their share of the profits. There is the confidentiality aspect. With a company, you have to file annual accounts.
Yeah.
Admittedly, with a private company with a turnover of less than 5 million or whatever the figure is, you don't have to show very much, but still there is some information. Partnership is completely private. The only outsider who gets to see the accounts really is the tax man.
Okay. All right. Well, I suppose there you are. That you can. I suppose it just depends how you want to set it up.
It depends how you want to set it up. But and the type of business. Yeah.
Of course. As you mentioned, it's very common amongst medical and legal professions. So, okay, that's very good. Okay, well, look, thank you very much for that. I really do appreciate it. Thank you very much for your time. Thank you very much for going through the Q&A. Lots of really valuable stuff in there, so thank you.
I hope so, anyway.
No, believe you me, a lot of really good stuff in there. So look, if you want to get in touch with Giles, is it Giles@gilesdixon.com, is that what you said?
That's okay.
He's also available if you log on to the membership platform. He is there under the experts page, so you can contact him directly from there. You can also just email us directly at Startup Richmond, and we will get the questions across to them. So lots of different options. So again, thank you very much.
Thank you very much, Sarah.
You're welcome.